Good morning, everybody. Welcome to the Flow Show. It's Tuesday, short week for us here. Hope you had a good day yesterday if you were trading around it. No surprises over the RBA for you guys, I hope. Morning, Stel. Morning, Kay.
Morning, you slacker. How are you doing?
Slacker. I'll tell you later about my last couple of days, mate. Slacking isn't the word. Anyway, How are you guys?
Morning.
Very, very well, thank you. Very good.
Have a good bank hole, or what you can manage out of it?
It was a holiday here yesterday, but I was working as normal. But all good. All good.
Yeah. K-Man?
Yeah, man. Very good day. Had a bit of
you say K-Man, and I always hear caveman. Always.
We should change that to caveman.
By the way, Kay, congratulations on the world snooker champion. I cannot believe it.
Exactly. I was preparing my my guy mentally yesterday to beat Selby. So no, I mean I've been quite busy as well, on that front. Oh, now
I hope the morph suit isn't coming out again.
Especially for someone who has never won a match before in the World Championships. Trying for a number of years, but yeah.
And he was the youngest one ever to make it to the World Championships and hadn't won a match in 10 years. Yeah. And then suddenly, I mean, the guy is amazing. Anyway, really, really fun watching him.
Yeah, very good. Very entertaining.
And he managed it by going drinking every night.
Exactly.
Sure, he has got some British roots in him.
Yeah, playing darts as well.
Good stuff.
Nice.
Good stuff. Right. Well, obviously, we've got a bit of catching up to do over yesterday, the weekend, and whatnot. So we'll get through some of the key points. Won't go into everything. It's PMI day again, and China came out the blocks over the weekend with some mixed numbers again. Manufacturing fell into contraction again, or back into contraction at 49.2 versus 51.9 prior. Let's see if I've got it all up here. I can't remember if I've got it up or not. Where are we? There. Non-manufacturing, i.e. services, that was still positive, though it dipped back a bit. So not all going in the same direction in China as well. Bit disappointing probably on manufacturing, considering we should have been seeing a continued increase in activity after coming out the virus stuff, but that's not to be, and it matches what we've been seeing in the PMIs recently. One sector doing well, one sector doing not so well, so that we'll keep a further eye on. The RBA, they decided that inflation was too sticky for them, and so their pause turned into a 25 pip hike. And the board expects that some further tightening of monetary policy may be needed. Inflation at 7% still too high, and it will be some time yet before it is back in the target range. Now, it's, in my opinion, this is again another question of credibility. They went on pause for a reason, and they pretty much booted that out for another hike. We're getting into dangerous territory if central banks are doing that so quickly. They're not supposed to be reacting that quickly. They're supposed to keep calmness in markets. And so when they say they're pausing 1 minute, hiking the next, the market isn't going to know what to think is going to be going on. And that's going to mess with markets' expectations and that sort of thing. What do you guys make of the RBA? Panic?
Yeah, no. Sorry, do you want to say, or shall I?
Yeah, go ahead.
Not panic yet, but definitely this is it's a shift. And could this be a precursor for what's going to happen with other central banks? Yeah, of course it could. I find it difficult to see central banks like the RBA or the Fed, for that matter, once they pause, to really go on a proper hiking cycle after that. I think we might see some adjustments, but I think they're going to be minor. So I wouldn't I wouldn't be quick in saying, oh my God, they're going to be doing another 2% now, because let's face it, I still think the year-on-year inflation numbers will keep drifting lower. Some countries more than others, obviously. The ones that are reliant on energy more are going to have bigger problems getting inflation down. So I think the EU and the UK in particular might have more trouble than, say, the US. But overall, I wouldn't say that this is the beginning of something big, but definitely a shift in central bank kind of sentiment and action. Yes, it is.
But what does it do though? Because we always talk that central banks don't act for what's happening today per se. They're always looking further ahead. So how can they justify going on pause 1 month and hiking again the next, and justify that's what they see further out? 3, 6, 9 months ahead, the medium term as it's called. It just shows they haven't really got a clue, doesn't it?
Yes. I mean, to be honest, we are at a place with in terms of inflation that we haven't seen in decades. So the central banks themselves have to deal with something which is quite different to what we've had for the last 20, 30 years. So that, for me, is one of the reasons why they're kind of trying to tiptoe around the situation and try to fine tune it. But do they? How shall I say it nicely? Do they know what they're doing? I'm not sure. They're kind of playing it by ear, right? So I don't know. What do you think, Kay?
Yeah, I mean, I was just going to say exactly what you said on your last comment. This is a situation where they are, as much as the rest of the market, trying to figure out what's the best way to, or the least harmful way to bring inflation down without killing the beast. The other observation I had when seeing that they went 25 is I think they have been influenced by what the RBNZ did by going 50. They were like, oh, if we don't do anything, perhaps the market is not going to be as stable as we would like it, because there's going to be a growing divergence between them and us. So perhaps we have to do something just to show that we haven't forgotten about the whole thing, and that we just are going to wait and see. Now I think is twofold. But I do think there's a bit of reaction to what the RBNZ did, to stay at a distance, but then their economy is bigger than the New Zealand, and yeah, I think there's a bit of those two factors that come into account. But yeah, I mean, there's just, as we say, as been said before, guessing as much as the rest of the market is doing. But it could be.
Does it inspire confidence though? Because central banks are supposed to know what they're doing. If forget the market impacts. If you're someone in Australia who's got a mortgage or looking to get a mortgage or something, and you hear that the RBA going on hold, and then the next minute they've hiked again, what does that do for your confidence that your own central bank can't keep control of stuff?
Yeah, I mean that's a good question. Where the simple answer will be it's not good for confidence at all, because that's the rhetoric side of the question, right? Yeah, I mean, for the street, for the man in the street or the woman in the street, it's not very good. On the other side, perhaps they've had signs that the street economy can still bear an extra 25 BPs for now without changing too much, and then they go on pause. But it's like every central bank, right? And I mean, in that respect, Powell has been pretty open in saying that it's worse. High inflation is worse over the longer term than hiking rates for a certain period. So perhaps they took a leaf out of the Fed's playbook as well. Yeah. For the rest, I really don't know what to say. Other than that, they did succeed.
Maybe Michael hit the nail on the head, because a lot of the data in Australia is quarterly, So, you know, they don't get a chance to see what's happening month to month like we do in other data. So, yeah, maybe that is an influence. But I think, you know, the RBA made a mess from the get-go. You know, we talk about central banks and their credibility. You know, a year and a half, 18 months ago, the RBA was still saying they won't hike until 2024, and here they are. So it's no surprise they're a bit jumpy. But I think it's just a question: if you imagine the Fed doing that, the markets go bonkers. Pausing and then
yeah, but then you talk about the markets again. I mean, if you look at the markets, and if you think that part of fighting inflation is to have a stronger currency, then perhaps on that side they were right to hike. Look at how the S&P is trying to handle inflation over there, and they are in the similar kind of situation. Only have meetings every quarter. So yeah, this you can criticize a lot, but there are probably factors in there who have been working relatively for them to go up, because the market was also very negative towards the Aussie. Recall over the whole month of March, April, the 2 months, the Aussie dollar has really suffered after the initial spike, right?
yeah.
So we have been coming off, especially the second half of May, and perhaps they said like, well, okay, we are at a level where turning around those prior levels, those March levels, we are at a level back there where the currency can benefit from us doing something. So yeah, I really would leave it myself to that, and now we see how the market takes it. Remember that after the RBNZ hiked 50 bps, the Kiwi didn't benefit for more than a few hours. Now let's see how the market reacts to the Aussie dollar. Yeah,
I think we may see the similar. From a tech standpoint, I'll be keeping an eye on that 68 level up there to see if we get a stretch move, but it doesn't look like it at the moment. But I digress. We shall move on.
It's a nice chart, by the way, there that you put up, especially that second half. Since the half of March, we've been really working on a decent range there, huh? Between 65, high 65s and 68. It's a pretty decent range.
Yeah. I remember us talking last week. We were looking to maybe pick some up if we got down towards this zone down here, sort of mid 65s. Unfortunately, we didn't. So now we have to look at the other side, perhaps. But yeah, decent range, and we know all about ranges of late in some pairs. But yes, moving on to the UK, and there was some inflation relief for UK shoppers. Apparently, the BRC retail inflation dropped to 8.8% from 8.9% previously. Food and grocery inflation still running at record highs there year on year, up I think it was 15.7%, but still big numbers over there, whichever way you look at it. And the market is pricing a 5% BOE rate again, fully priced in, the first time since the 21st of April, so a couple of weeks ago. But more and more the market is swinging around to the fact that BOE rates may need to go higher. Speaking of inflation, and we've had a ton of data from that as well. Eurozone inflation came in touch softer on the core number, 5.6% versus 5.7% expected and prior. Headline CPI did tick up as expected to 6.9%. That's in the flash readings. But as we've seen from other countries, country by country, inflation isn't playing ball. Italian HICP, the Eurozone measure, jumping to 8.8%. So beating expectations by a whole 100 pips and going higher than last month. The same for CPI. That was expected to rise compared to the other one, but it's gone up even further to 8.3%. Seen similar Spain, France, etc. So again, inflation is proving to be far more sticky, and that's going to play into the ECB coming up this Thursday. Also of importance from the Eurozone and the ECB was their April Euro area bank lending survey. This has been something that has been touted by several ECB members as to whether credit conditions are tightening, that old buzzword, because they do see it as having almost the same effect as rate hikes. So if that's happening to a degree because of rate hikes, that may influence their decision making in regards to further hikes. So banks did tighten credit standards more than expected in Q1, and consumer credit is set to see similar tightening pace in Q2. From the details, they said that banks reported a further substantial net tightening in credit standards for loans to firms and for house purchase. Demands for loans decreased strongly, driven by rising interest rates, lower fixed investment and weakening housing markets. Ongoing reduction in central bank balance sheet is linked to TLTRO repayments at the end of full APP reinvestments are contributing to weakening lending dynamics. So a lot of jargon there. What does it mean? It obviously means that rate hikes are starting to bite, but there's also seeing weaker demand in various areas like investment and housing markets, which, as we've spoken about before, the housing market is something that is a good indicator if things are turning a bit sour, because it's usually one of the first to move. What does it mean for the ECB? It makes the ECB rate decision pretty much, I would say, nailed on for a 25 if they're going to hike. I still think on the inflation side of things, there's a risk of a 50. But I think that the last hike, the last 50, was maybe a bit of a concession by the doves to the hawks, so maybe they get that repaid, perhaps by only going 25, but given a message that they're going to continue maybe with hiking at that level for a while longer. But what this lending survey perhaps does is put a bit of doubt into expectations for further QT measures to come, maybe June, middle of the year, where a lot of people are expecting them to increase QT. That bank lending survey might change that mind, and they might decide to keep some of that liquidity still in the market. What do you make of it, guys, and particularly that survey? Is it going to have a big impact?
Hey, sorry, I'm just doing something. Give me 1 minute. I'll be right back. Okay.
Don't worry. Yeah, I thought it was pretty interesting how the market reacted to it. It did weigh a bit on the. Let me just have a quick check again this morning. It weighed a little bit without doing too much on the short end of the European curve, but we're already catching up again. So it's a short-term impact, but those things are going to be important going further down the line, because as they say, they have, as you also said, it looks like starting to bite, but then you need confirmation, right? If it's a one-off or a confirmation.
Yeah.
But if it's a confirmation, I think then that may signal that the ECB is close to their pause as well, you know, and they will not really like conditions to tighten too much further, because that's going to hurt the street economy, of course, and they have to be aware of what's going on there.
Yeah, exactly. So it definitely puts add some spice for the upcoming ECB meeting.
And if I may add to that, it's funny to see the reaction on the euro, because the eurozone printed. Well, the core CPI came down 1/10, but then the headline CPI very stubborn at 7%. But the market reacted on those banking, lending, and the M3 data. So that's for us interesting to see what the market reacts to, and we are seeing that slow shift to other data than just inflation for the currency.
Yeah, and that's been the case as we've heard from the Fed as well. You know, Powell banging on about conditions, tightening conditions, financial conditions. It's been a bit of a key phrase or buzzwords for the last couple of months at least, and as Kay says, it looks like it's going to continue. And he's right. We've got to know what sort of stuff will move the markets. Yes, inflation data, other data will do, but if central bankers are looking at other items, we've got to look at them too. And that bank lending survey may be a market mover from now on, whereas most times no one would give it half the time of day. Mike's asked a question. Core retail sales volume wise were down year on year on average across Southern Europe. Can I confirm? I haven't really caught up on the retail numbers. There were German numbers out. Where were they? I had them up a minute ago. Where have they gone? Am I going mad? I thought I saw retail numbers.
Yeah, German retail sales minus 8.6% year on year.
8.6%. Yeah, month on month, soft as well. So yeah, it doesn't look anything is going gangbusters there. Of course, this data is playing into the GDP stuff, of which we've already started getting the flash readings. So we need to keep an eye on things like that. Retail sales, they can be very volatile, that I will say. So yeah, it does look like big numbers, but again, it's the trend is your friend. So we need to see, is this just going to be a more one-offs? Are we going to see more up and down numbers, or is this going to be a bit of a trend? But yeah, those German numbers particularly don't look very good at all.
They are closer to reality compared to other retail data coming out in other countries, because if I'm correct, Germany does adjust for inflation, their retail sales. One of the only countries to do so. Yeah,
that is a good fact. It's something that Steve likes to bang on about as well. So yeah, important to take that into consideration as well. But we're just going to jump back now to yesterday in the US and looking at that data. And again, really some mixed numbers. You know, the headline number improved a bit again, but you know, we're still seeing contraction there in the orders contraction. Employment, again, moving into expansion. It'd been in contraction, it'd been in expansion. Now we're popping into expansion again. But I think more importantly, the market's reacted to the prices paid number, which moved quite a decent jump into expansion again. Obviously, this is the inflationary component that people look at in the PMIs. So that jump there seems to be getting expectations for the Fed up again, of which we need to look at. Our old mate Timmy Leaks at the Wall Street Journal, Nick Timiraos, said that the Fed are set to raise interest rates to a 16-year high and then debate a pause. And that officials could keep their options open in crafting signals around the end game for increases. Obviously, we've got the Fed this week, and what are we expecting really from it? Well, the market's expecting a great chance of a 25 pip hike. Their probabilities has that at a 95.8% chance, with unchanged marking the other portion, the other 4.2% of those expectations. So it seems like we're pretty nailed on for 25. I think that's going to be what they do at 25. I think where maybe the market is not ready is for them to continue hiking, if they indicate that they're going to continue hiking. And again, looking at the RBA and what they've done, I don't think we'll see the Fed going into that sort of situation. They may indicate a pause, of course, or one may be coming, but they'll be worried about getting caught out and indicating a pause and then having to raise 2 meetings later. So I don't think they'll get into that boat. But they are already quite high on their rate. You know, we are up around the 5s, so this is going to push them well into 5%. And I think that's where they'll be happy to be. Whether they want to go higher or not is another question. But I think the main message we'll get from them is this higher for longer. And that's the fight they've got against the market, because the market is still pricing cuts by the end of the year, which I think is wrong, unless we see economic activity really taking a nosedive, or even the jobs market taking a nosedive. It's going to be very hard sitting here right now to see the Fed cutting by the end of the year. but we never say never. What are your guys' early expectations for the Fed this week?
Well, for me, I sorry, carry on, go on.
Exactly that. I think they do 25. They go into the dot plot area of the 5-10, possibly target rate or final, but no, you have to be careful when you talk final. And it's exactly that. I think the Powell has been walking this fine line enough now to know what he cannot or will not say to the market. Yeah, I think that's pretty much where we are. We'll leave everything open, probably fight back a little bit against possible cuts if the market leans too far versus that. But it's really going to be a market. He can say that compared to where they projected to be, they are there now, but now we leave everything open. And I reckon that's going to be the case, because if you look at the data, we were starting to see weaknesses on those secondary data, nearly all of them, right? And then yesterday you come out with the ISM, and you will see all those numbers in the green. You see, of course, and even the employment index is creeping back above 50. So we can't really say that the US data are falling out of bed, right? So that still will hold them in well, tightening bias or more neutral, but possible for more tightening. But I do think he has to be a little more neutral now. But he will work the fine line as he usually does.
Yep, Stel?
Yeah, I agree with what Kay's saying. I don't think the Fed is going to shock the market in any way other than doing a 25. The numbers are, with the exception, I mean, obviously yesterday we had the number which was stronger than expected, but the numbers are not doing great. But inflation is staying relatively high. The problem that the Fed has, and this is something I wanted to mention in terms of a news item as well, you know, they said the Treasury revised their borrowing target from April to September from just under $1 trillion to 1.4. So they're going to be borrowing a lot more, which means that they really cannot afford to be having much higher rates. So the problem they have is they need to be, or at least they need to be seen as trying to tame inflation, knowing that they really can't raise rates much higher than here. So it's a tough position to be in. And I think they're going to do everything they can to avoid hiking if they can. But on the other hand, you know, the data is the data. And if inflation keeps, well, inflation has been coming down on a year-on-year basis, right? It's been coming down from almost 10% down to, what was the last time, 6%, or I can't remember. So the path is still there and the path is good, but it needs to keep going. If it doesn't keep going, then they're in a big problem. But for the next meeting, I think for this week, I think 25, the language is probably going to be balanced because it has to be balanced. So do I think they're going to say, okay, we're done? Probably not, but I think their tone and the wording and everything that they say is going to leave the door open for that. Definitely, they can't. I don't think they're going to come out all guns blazing saying, "Okay, 25 today," but really, we're not done yet. I really don't think they're going to do that. Yeah,
no, I'd agree with that. And I'd say they're not going to make the mistake of the RBA and saying we are definitely on pause. They will keep all their options on the table.
Yeah, it's an easy statement tomorrow if they want to. They just have to put 2 words in there, data dependent, and that's it.
Yep. Let the market do the rest, which gives us our moves, which is good. Michael asks, so higher for longer is hawkish for the dollar since we are expecting cuts sooner than the market is expecting. Right. I don't think we're any sort of extremes for expecting rate cuts. That's when you'll get the moves. If you remember when we started getting the pivot stuff happening into the latter part of last year, you know, the market was trying to have a go at trading Fed cuts, and it kept getting the slap round the mush. And then coming into this year, you know, we saw the data turning, and then the pivot has really got their teeth into it. and sent the dollar lower. So we're a bit more balanced now, and you can tell that from the price action, where we're maintaining some good ranges. And I don't think we're at peak cut pricing yet or expectations. So I don't think it's super hawkish for the dollar. If any of those cuts get further priced out, we've just got to watch what happens in things like yields. And, you look at something like the short end, which is where those numbers are going to affect, or those expectations are going to be seen the most. Here we are, still below, 2 years out, we're still below where current Fed rates are and expected to go higher. So, is this cuts? This is more like where rates may come down to at the moment rather than getting into cuts. But a point I made this morning when I was speaking to Michael Brown is that if we do enter rate cuts, we shouldn't expect rates to be going all the way back down to zero. The next move from here is getting rates to neutral. And that neutral area is maybe somewhere between 2 or 3%. So even if we're at 5.25%, we're only going to be cutting 2% maybe from rates to get back down. Unless things really crater in the economies, we're not going to zero. We're not going to QE again. So even if we do get rate cuts, they're going to be fairly minimal, particularly in some countries who aren't even at 4%. So the rate cut trade isn't going to be big in terms of the size of cuts and where they go to. And that's probably going to be reflective in expectations and how far the market may move. You're not going to see dollar yen, for example, going down to 100 based on the Fed maybe cutting rates by 200, 250 points over probably 6 to 8 months. It's not the same as when they were hiking from 0 all the way to 5% that we saw last year, just taking the dollar side of the example there. So it's not going to be the same as when they were hiking. That needs to be known. Right, just keeping with the Fed, and Biden is apparently looking at 2 new members to put on the Fed board. One is Adriana Kugler, who's an official at the World Bank, potentially in the running for the vacant Fed governor job, and Jefferson is already in play. Sorry, mate.
Is she a cougar? Sorry, couldn't resist.
Oh
my God.
And Jefferson, who is already on the board, may be in the frame to take over from Brainard as vice chair. So just a couple of names in the hat being thrown around there. No doubt the market will do their hawk dove exercises and research on Adriana in particular. Over to former Fed Chair Yellen, now in charge of the Treasury, says that debt limit measures may be exhausted by June the 1st. And the US Congressional Budget Office has warned that it sees a significantly greater risk that the Treasury will run out of funds in early June. We're heading to the usual bum fight, last minute, 11th hour, 59th minute, 59.999 seconds decision that's going to have to be made. Biden has apparently invited all 4 congressional leaders to a meeting at the White House on the 9th of May. Now, in both houses, they're all throwing around their own ideas and bills for resolving the debt limit, which no doubt will stick at an impasse. This meeting may yield some positive news that they can actually agree on something. I still think the base case is we get a big can kick for another year. It would be probably a surprise to the market if they actually formulate something more stronger than that. But if they do, that's going to be probably positive for the dollar and US assets in general. But I still think we're not quite there on fully trading it. The possible shutdown and running out of money, which is always not as bad as it sounds on paper. We just don't get data for a while. Federal programs don't get paid, that sort of thing. But the ramifications the market will make is what does that mean for paying debt and that sort of thing. And that's where the market gets a bit antsy over it. What do you guys make of the latest ping pong match with these clowns.
The debt ceiling,
Yeah,
the debt level, should I say?
either of them.
Yeah. I mean, it's the same stuff over and over again. I'm not giving any attention to that, really. I am exhausted. Just like you said, all options are going to be exhausted. We are all exhausted. So, but is there going to be a little bit more theatrics? Yes. But bottom line, is the US going to default? Absolutely not. So, maybe there's another government shutdown for a little bit, the same old stuff, and the market knows it. That's the thing. So I know I sound a bit complacent about this, but I see no reason to panic in any way over it.
Yeah. Okay. Any thoughts?
No, I'm just watching the CDS spreads moving out a little bit more, just a couple of BPs because of Yellen bringing the deadline closer to where to today. But yeah, basically they're buying some insurance to do those on those CDSs, and then once they find an agreement, those spreads will come down again. And then yeah, I mean, there may be a bit of nervosity on the dollar as well if by the end of May nothing's done yet. But as we all know, usually close to the deadline, they'll find an agreement. So perhaps if that's the way that the market is going to trade it towards the end of May, perhaps that would create somewhere an opportunity for dollars.
Yeah, agreed. And we should say though, it may be a very low risk, but a risk is still a risk. I think it was Bruce Reuters, or was it Jamie? No, Jamie Reuters, who Dale had on, I think, last week or so ago. They said that in the last 70 odd years, they've done this exercise 78 times, I think it was, where they've got to an impasse and then kicked it on and kicked it forward and fudged it over. So, history would say this is just going to be yet another can kick and move it forward to another time. But we can never say never, of course. Some bidder may want to make a point going into an election year that they get it sorted once and for all. We can but hope. Lastly, China is apparently, or has been apparently, stopping thousands of citizens and foreigners from leaving the country. And that was according to analysts done by Reuters on Chinese court records, looking at cases that mention exit bans between 2016 and 2022. This is all coming on top of China strengthening their counter-espionage laws last week, making it easier to impose such bans. I think this is just another headline that goes into the geopolitical part that we've been seeing of late, tit for tat stuff or stuff going on with Russia, US, so on and so forth. This is just yet another thing that potentially shows a bit of worry on the Chinese side. So much for opening up. Everything's looking like more closing down. But as I say, into the pot, and we'll monitor that moving forward. So quick look before we get into the prices of what we've got coming up this week. So big week, obviously, for data. We've got lots of job stuff coming up. That starts later today when we get the JOLTS numbers. That dropped below 10 million for the first time since May 2021. So we need to keep an eye on that to see if there's any worries from employers who are perhaps tightening up on offering positions. Again, that gives a little bit of an indication what's going on in the jobs market. Further services PMIs coming on Wednesday ahead of the Fed. ADP obviously will be out then too. So we'll get to throw the dice over what the NFP numbers might be. That's reminded me, got to do the NFP competition this month. So I'll get on that later today. Then on Thursday, we get the rest of the services PMIs from around the world, and obviously the ECB decision coming in there. And I would say keep an eye on this Challenger Gray job cut report. It's not one that market really moves on or one that the market pays that much attention to, but the numbers have been coming up quite heavy of late compared to, say, last year when we were perhaps seeing 25,000 layoffs each month. We've had 103,000, 78,000, and 99,000 over the last 3 months. So activity in job cuts is picking up there. Again, that will give an indication what may be going on in the jobs market. And then obviously on Friday, a few bits and pieces of data, but it's really going to be about the NFP, which is double bubble with the Canadian jobs data as well. So lots to get our teeth stuck into this week. You guys got any early expectations for the NFP?
Don't know really. I mean, the trend has been, sorry?
180 is expected.
Yeah, the trend has been for slight underperformance, but really, I have no. I don't want to guess. I don't know. I will guess for the competition, but
I was just about to say you're powder dry for that, aren't you? You're not going to give Kay any hints of what you're going with. It's all a closely guarded secret. Kay, can I weasel anything out of you for the NFP?
I recall, like over a year ago, I had the first one. I nailed it to the 1,000, and then from then on, I've been actually more than 100 or 200K apart from where the number came out. So I mean, I'm going to say 111, 111, and then don't copy me.
Don't copy Kay. Right, so quite a bit to talk about in price terms. Kay, I'll let you come in because I've been waffling on for long enough. Do you want to take a little look at the prices?
Yeah, shall we? Okay, I'm going to just give a quick look at some stuff, and then perhaps concentrate on what's been going on in the yen, because that's obviously been a big mover after the Bank of Japan on Friday, and then we'll see where those processes are. Gold, first of all, a bit of the shorter term one here should perhaps, it's not very accurate, this line, so it's more like here-ish. It's turning around this 1980, 1970s we've been talking about. So that's the level where you need to have a look at, because that's been holding over the past half a month or so, and then below there it could go into the 50s, but perhaps the bigger zone is going to be around the 1930 again if we continue to come off. So far we're respecting this little bit of a triangle as well. So the top side 2007, 2010. So we are in this range, and I don't have much more to say about this range than what it really shows. Silver has done quite a bit of a yo-yo, as we can see here. It's really been doing a yo-yo, but we have to see that this zone, the 24.5, 24.60, is putting up a fight right now. A couple of us are looking at this zone here, anywhere between 23.65 and 24 to get in again in what we sold. So is FOMC going to give us something? Perhaps, but if in the meantime the data hold up, I'd say that this 24.5-ish zone could actually possibly be enough, depending on what Powell tells us tomorrow. If we start to move back above, we need to get back here above is a prior high as well before the shoot higher and then the move back down. We need to get back above 25.25 to start going again. All right, so this is going to be the zone to watch, in my opinion. Oils, finding it hard to keep bounces. I think that's the theme that I would say here. We went below. We talked about that in the room, and it's kind of the ideal thing, or the ideal thing, or what could be feared or expected that really happened. We said we're going to close the gap and then probably go and punish the people who want to buy the closing, the close of the gap, and that's exactly what happened. And then we saw the rebound, but we are coming back to this zone, and it doesn't look very very positive right here and now for me. I think we can easily retest those lows. Same on Brent really. It had the rebound as well. We closed the gap earlier than on WTI. We closed the gap earlier on Brent, if I recall correctly, because we were pretty early back just around 80 here. We did exactly the same, went through it, bounced, and now we are back along this trend line, but it's a fast sloping trend line, and we keep tagging along. So there may be some more of this gentle slide, or perhaps painful for some slide in there. All right, let's see what's happening on the end. So we had this Bank of Japan, pretty steep rise. And once we went through this 135.10, 135.10, 135.5 zone, we didn't stop. Now, there is a bit of interesting traffic around this, up to 138.20 or so, 138.25, 138.17. There is traffic. We've got this bit of a trend line. We've got the prior highs, and for the time being, we're stopping shy of 138. 138 has been a target on many charts and stuff, where people looking at different stuff saying that 138 could be a bit of a target. And we have to look at where the 200 DMAs right at 137, 136.90, 98. I think that's your intraday range to observe right here. For the more medium term, if we can call it medium, or into FOMC and the end of the week, the NFPs, who can change the picture for the dollar, of course. I think for as long as we're above 135, 135.5, that's going to be your major zone now for the dollar yen. For as long as we're above, I'd like to think it's more bullish than bearish, this one. Kiwi yen, we just traded above this 85.10.20 zone, prior high, but now for the time being we're hanging around. I think this is important enough on the daily close here, 85.10.20, whether we're above or below on the Kiwi yen. So that's your zone to watch for the end of the day, the real start of the week, I'd say. Aussie yen, from hell to heaven, where nobody wanted it. Last Wednesday we did the low, then trying to figure out what was going to happen, and this is then the BOJ broken back above this 89 level, didn't even look at the 89.70, and then today we were hanging around this trend line here, when the RBA came out, and RBA gave it another push higher. As I'm saying as well, this is a traffic zone here, right? So I'd say keep an eye on what's happening. If we start to get back to 91.60 for a starter, then 91, the figure, is going to be pretty decent support right now, I'd say. And then, but on the top side, we need to respect this traffic zone, in my opinion. It's been traded quite a bit. So keep an eye on what's going on. If we reach that zone, we had this double top last time around, and that then before double fib action around 94. But I already say 92.35, 93. The figure is big enough to keep a close eye on. Euro yen, I don't know. Ahead of the ECB, I said last week, I thought the euro process were about to cap. We've seen it against other currencies, but then the yen threw Bank of Japan threw things a little bit upside down. So we did that top today, I don't know. I don't know if it has a lot further to run. This is a weekly, so it's a long term. This is the whole global financial crisis, European crisis, into the even, and I forgot to mention that, into even the big quake in Japan, and then the low, and that is when the start of Abenomics around here, when Abe got elected. So it's probably important enough to keep an eye on what could happen at this 78.6 of this whole triple whammy decline on the euro yen, which we saw at the over the turn of the 2010s. It's lying at 153.60, and if you look at this trend line, it's about where it's going. So if you see a push over the ECB, and we're getting into the 153s, I'm going to have a look at it, because, as I was saying earlier, I think ECB could be a bit of a. It's just an impression that I have. Could be marking a little bit of a top for the euro, but let's see, because it's already filtering out or coming back down. Cable. How much more magneting do we want at this 124, 40, 50, right? We're always coming back to it, and then we decide what we're going to do with the next 50, 60 to 70, 80 points, and it's been on the way down, it's on the way up. We did have our end of the month pump in the cable, and then we have been gradually coming back from these high levels. This was clearly end of month activity on the sterling. Sterling really got bought up quite aggressively into the end of the month, and then now we're coming back down. So if cable wants to go higher, it will have to overcome really this 124, 125 3/4, 125.85, give it up to 126 really. This is going to be a big zone to overcome, in my opinion. In the meantime, I'd rather see it until FOMC in this range. What else? Sterling yen is a different animal, but look at this prior high, 172 and a quarter, and what did we do today? Right around there again. So we could be building a double top right now in the sterling yen. But if that wouldn't be enough, then I don't know. I don't see much really. Okay, you have a bit of 175 in there. 175 is actually pretty decent around here. But then we'll have to play darts and go for the 180 if that weren't to be enough. But first things first, let's see what's going to happen next week as well. We've got the Bank of England, so they may make this pause or in turn push higher. Keep an eye on what's happening anywhere. 168, 30, 40, 166.5, 165.5 are now clear support levels on if we would start to come down. So these are the ones where you have to pay attention to. And yeah, I want to show this one. We ran into this resistance zone in Asian time, and we tried a couple of times up there in Asian time yesterday as well. I've just stepped out of the rest of my longs actually, Ryan, because I'm just, I don't know. I don't know what's going to happen over FOMC. We can always re-enter if it goes back down closer to 690 or so. Well, that's my view. It's coming back a little too easy, and I prefer to take the rest of the pips and reassess what's going on in this dollar China. It's not going anywhere too fast. And I'm going to leave it to that for today.
Okay. Thank you, mate.
Yeah, I'm passing back.
I love case charts. Seriously, I do.
Why is that?
Yours not so much, Ryan. But yeah,
I used to get mocked for all my multicolors, and everyone's doing it.
No, in my case, it's just because I don't know how to take away those colors. So, all right, back to you, mate.
I'm a shepherd. I'm a shepherd, not a sheep. There we go. Anyway, right, I'll take it back quickly because just a couple of things I'd like to highlight. Let's take those back. I'm going to start off with this $1 because I took a bit off in this move up yesterday. Some people will call this a bull flag, whatever, and we made the break. That for me is going to be the area right in there where this part of the rally is going to be tested. If we get back below there, then perhaps having a look back at the 91. Yeah, it has run into trouble up here, exactly where both Kay and myself was expecting. But I think given the data and given what's going on with China, the geopolitical stuff, I still favour wanting to stay on the long side of this pair. I think we could, if we get above this area, we're going to be having a look at 7, and then we should be on watch for any comments coming out about from officials about how they're going to deal with those sort of currency moves, whether they're happy with it or whether they want to indicate the brakes need to be put on, which is always a close signal for that. For dollar yen, my shorts aren't looking too hot at the moment. 138 is my level for this. I'm short from starting around 132 for a bit of a long-term play, but even I've been not expect. Well, I have been expecting a bit of a rally after the Bank of Japan, but it's looking very strong, and I'm not too keen on that side of things. So 138 will be my assessment level for that. Obviously, if we're hovering around there over the Fed, it could be fireworks. I've currently got my stops well above 139, above this 139.50 area, which is the fib of this move. So hopefully they're out the way. But if we do break 138, I'm going to be thinking again that perhaps I'm wrong timing with my thoughts on what's happening with the Bank of Japan and stuff going on with the US data. But conversely, I'll just show the band now. It does mark a potentially quite decent consolidation range, which is why that's going to be very important up at 138. So even if it does break it over the Fed, where it finishes after the Fed and potentially the NFP is going to be important. If we sail above it, but come Friday afternoon, we're closed back below, that's potentially going to be a strong signal that we've seen a bit of a top coming into play. So that's my worry area for this one. Sorry, Stel, did you have, was that you?
No, I just coughed, sorry.
Okay. Cough on your own time, please, mate.
Oh, that was good. Good day's roundup, I think.
Yeah, thank you very much. Yeah, great stuff from you and the K-Man. Mike asks, am I still playing ping pong with the Hong Kong dollar? No, because for some reason margins went through the roof. So I'm not paying the money to sit in those trades anymore. Not that Hong Kong dollar's doing an awful lot. We're back up at the band at the top there, and we're glued to it at the moment. So maybe something I'll look back at if margins come down a bit. But no, I'm not tying up a lot of capital, far more than I deem necessary to sit in that one for ages. So no is the answer to that one. Right, we'll call that a day for today. Thank you very much, boys and girls, for coming to the Flow Show. Thank you always to my colleagues Kay and Stel for their very important input into things. Have a great day. We shall see you all tomorrow.
Thank you, Ryan. Thanks, Kay.
Everybody.